I think Supermicro will pretty much track the market over the next 5 years, leading to a stock price of about $60. And I'm going to tell you exactly why in the next 5 minutes. Let's begin. First, let's understand the business. Supermicro isn't the sort of household name you see on laptops, PCs, or anything like that, but it is the name behind a lot of racks humming away in cloud and AI data center. The company designs and assembles complete servers and storage systems. Think chassis, motherboards, power, networking, even direct liquid cooling, then ships them as ready-to-roll solutions. About 95% of revenue comes from those turnkey boxes, while accessories and services make up the rest. The secret sauce, a Lego style building block architecture. Now let's do a performance check. How has the stock been treating investors? Right now, between New Year's Day of 2023 and mid 2025, Supermicro's market cap has rocketed from about $4 billion to roughly $24 billion, a six-bagger in about 2 years, if you were lucky and brave enough to buy early. The ride, though, has been about as smooth as a dirt road. The share prices has chopped in half more than once on supply chain scares, guidance trims, and legal and security issues. Speaking of trims, quarter three fiscal year of 2025 showed the dual nature of this AI beast. Revenue was up 19% year over year to $4.6 billion, but gross margins slid to 9.6% thanks to cost inflations and competitive pricing. Management dialed back its full year sales guidance to about 10% down, blaming AI customers delaying purchase orders. Translation: big deals are still coming, just later than hoped. Even so, the balance sheet remains sturdy, about $2.5 billion each in cash and debt, and Supermicro just recently dodged a NASDAQ listing, but it's still something to keep an eye out for. Now, the pool case. There are three tailwinds that could keep Supermicro climbing. First is the AI and cloud gold rush. Every enterprise wants ChatGPT style smarts, and that means GPU stuffed servers by the truckload. Supermicro just inked a $20 billion multi-year contract with data vaults for AI campuses in the Middle East. Now you also have first mover tech agility. While Dell or HPE can take quarters to validate a new chip, Supermicro often ships it in weeks. The speed lets early adopt customers, especially AI labs, turn new chips into real-world performance faster, and they tend to pay a premium for the privilege. The company is also pioneering in liquid-cooled racks, which are a perfect example of what is needed in the AI space right now. Finally, and third is market share grab and scale. From fiscal year of 2019 to 2024, revenue compounded at a 34% a year. That is way faster than any of the other players. As long as it keeps underpricing the giants without blowing up quality control, the share gain story can keep rolling for Supermicro. Next, let's look at the bear case, and there is one big bucket of risk: margin squeeze. Servers are basically metal, motherboards, and muscle. Commodity parts glued together. Dell, HPE, Lenovo, and even NVIDIA's own DGX reference systems are clawing at the same AI pie. Hyperscalers like Amazon and Google, well, they design their own servers in-house. That chucks up the price pressure. We already saw gross margins slide from mid-teens to single digits. Another round of discounting or a spike in component costs could turn today's profits into tomorrow's rounding errors, or even worse, tomorrow's lack of profits. Now, my prediction. To recap, Supermicro's nimble architecture and red-hot AI demand provide a solid growth runway. Its speed to market and expanding customer list creates a defensible niche, and secular shifts toward cloud and AI infrastructure should keep revenue moving forward. On the flip side, heavyweight rivals, razor-thin margins, and kind of a geopolitical pressure right now could crimp profitabilities. Now, balancing those forces, I expect Supermicro to deliver returns broadly in line with the S&P 500 of around 8% a year, making this stock at closer to $60 over the next 5 years. That's respectable, but not the rocket ride we just lived through. I'll watch margins and other headlines like a hawk. If either breaks the wrong way, the stock could lag. Conversely, a major design win or a stickier gross margins could nudge performance towards the high end of market like. So there you have it. That's why I believe Supermicro will deliver returns roughly in line with the market of about 8% a year over the next 5 years. Now, what do you think? Tell me why I'm right or wrong in the comments below. And don't forget to like and subscribe. Also, go to fool.com/invest to receive the top 10 best stocks to buy now.